Every business records hundreds of transactions every day, buying goods, paying rent, receiving cash, and many more. But do you know where these transactions are recorded first? Welcome to this video on Journal in Accounting, the very first step of the bookkeeping process. In this session, we'll understand what a journal is, why it's called the Book of Original Entry, its format, features, objectives, and much more. So, let's begin our journey into the world of accounting, starting with the foundation of it all, the journal. Introduction. A journal is the first book of entry in the accounting process. It is where all business transactions are recorded first, before they are transferred to the ledger. The journal is the book of original entry where every business transaction is recorded first, in chronological order, using the double entry system. This means that whenever a transaction takes place, like purchasing goods, paying rent, or receiving cash, it is first written in the journal along with details of which account is debited and which is credited. It helps maintain a complete and systematic record of all business activities. Origin and meaning. The term journal comes from the French word jour, which means day. Hence, the word journal literally means a daily record. In accounting, this implies that every transaction is recorded as and when it happens, on a day-to-day basis. Because the entries are made in the order of their occurrence, the journal is called a chronological record of transactions. Features of a journal. Let's understand the key characteristics that make the journal important. Chronological record. All transactions are recorded date by date. White right pointing backhand index example, if goods are purchased on 1st October and salary is paid on 3rd October, 1st October entry comes first. Book of Original Entry. The journal is the first book where transactions are recorded, that's why it's also known as the Book of Prime Entry. Double Entry System. Every transaction affects two accounts, one is debited and another is credited, ensuring accuracy in records. Narration. Each entry includes a brief explanation written in brackets. This helps anyone reading the journal understand the reason behind the transaction. Uniform format. Journal entries are made in a standardized format, making it easy to read, post, and verify. Basis for ledger posting. The information from the journal is later posted to individual ledger accounts, which helps in preparing the trial balance and final accounts. Format of a journal. A journal usually has the following columns. Date, the date on which the transaction occurred. Particulars, the names of accounts affected, debited and credited, and narration below it. Ledger folio, the page number in the ledger where the entry is later posted. Debit and credit columns, the amounts to be debited and credited respectively. Narration. Narration is a brief explanation written below each journal entry, within brackets. It describes the nature and purpose of the transaction recorded. Example. Being goods purchased for cash. Importance of narration. Explains the transaction at a glance. Helps auditors or users understand entries without referring to supporting documents. Reduces confusion and provides transparency in records. Objectives of journal. The main objectives of maintaining a journal are: to simplify the ledger by classifying transactions before posting. To provide explanations through narrations. To ensure accurate application of the double entry system. To help resolve disputes or misunderstandings by serving as proof. To maintain a permanent and chronological record of all transactions. To prevent omission of any transaction. To facilitate preparation of the trial balance. To serve as legal evidence in case of audits or investigations. To detect and correct errors during posting. To help in preparing final accounts such as the profit and loss account and balance sheet. Types of journals. There are mainly two types of journals. 1. General journal. Used for recording all types of transactions. Commonly used by small businesses. Example, adjustments, rectifications, depreciation, etc. 2. Special journals. Used in large organizations where similar transactions occur frequently. These help save time and reduce repetition. Types of special journals include: Sales journal, records all credit sales of goods. Purchases journal, records all credit purchases. Cash receipts journal, records all cash inflows. Cash payments journal, records all cash outflows. Sales returns journal, records goods returned by customers. Purchases returns journal, records goods returned to suppliers. Advantages of maintaining a journal: ensures systematic and chronological recording. Makes it easier to locate errors or omissions. Provides complete transaction details with narration. Simplifies ledger posting and trial balance preparation. Serves as legal and audit evidence. Useful for accounting analysis and learning purposes. Facilitates easy verification by auditors or accountants. Limitations of journal: time-consuming when there are many repetitive transactions. Not suitable for large businesses, hence special journals are used. Difficult to find totals quickly. Posting errors can occur if entries are missed during transfer to ledger. Requires more clerical effort compared to computerized systems. To sum up, the journal is the backbone of the accounting process. It's where every business transaction begins its journey. By recording each transaction in chronological order with proper narration, the journal ensures accuracy, clarity, and a strong foundation for preparing ledgers and final accounts. Remember, a well-maintained journal is the first step toward reliable financial records and effective business management.